Lesson 10. How to stalk a low risk, high reward entry point. Welcome to Lesson 10. My name is Sam Eder. I'm a global macro currency trader and the owner of FXRenew.com. This is the Advanced Forex Course for smart traders. You've done your homework, you've found a damn good setup, and now it's time to execute. The temptation is to jump in straight away, but now is the time for patience. It's time to stalk your entry like the cheetah stalks its prey. As a Forex trader, you should have an array of simple entries at your disposal that help you uncover low risk, high reward times enter into your chosen positions. This will allow you to wait patiently for a time to enter that will improve the odds of you having a winning trade, while at the same time maximizing rewards and minimizing risks. Market wizard Colm O'Shea said, "I think implementation is the key in everything. Implementation is more important than the trade idea behind it." Simple is better. Decisiveness is critical when it comes to your entry. In a fast-moving market, or if you are trading with the trend, you need to be ready to pull the trigger or else you could miss out on the move. A confusing and complex entry approach is to be avoided. You don't need 5 indicators on a chart to all line up perfectly to time your buy. Instead, look to use tools and chart patterns that help you to recognize the market for what it is, and allow you to execute flawlessly when the time is right. With entries, simple is very much better. Market wizard Tharp said, "Stalking means making sure the odds are even more in your favor by paying attention to the smallest time frame possible for you." One of the goals of a patiently stalked entry is to improve the risk-reward on the trade. By moving to a lower time frame, it allows you to time your entry so that you can tighten your stop loss. If you have a tighter stop loss, you can take a larger position with the same amount of dollars risked, meaning your profit on the position can be much greater. If you have a setup that gave you the potential to make 300 pips with a risk of 100 pips, you would have a risk-reward ratio of 1 to 3. If during your process of stalking an entry you were able to get into the trade with a risk of only 50 pips, then you would have a potential risk-reward on the trade of 1 to 6. On this weekly chart of the Euro-USD, we have a double top formation off resistance, signaling a change in trend. If our profit target is on the next level of support, we have a risk-reward ratio of 1 to 1.06, which is not great. If instead we stalk an entry on the 4-hour chart, we can enter the trade with a significantly improved risk-reward ratio of 1 to 3.61. Market wizard James Rogers said, "I just wait until there is money lying around the corner, and all I have to do is go over there and pick it up. I do nothing in the meantime." Do nothing unless there is something to do. Many traders don't trade to win. They trade to get something else that they want from the markets. So instead of patiently stalking an entry, they feel the need to always be playing. But you can't rush the markets. If you try and force a position, it's pretty much guaranteed to come back and bite you. If you don't know what's going on, if you don't have a superior risk-reward trade lined up, then you should not be trading. Simple as that. If you have made a profit, there is no need to go out and place a new trade in a rush of overconfidence. It will come if you give it time. If you have a losing trade, you don't need to do something to make it back. In fact, that is the worst thing you can do. Revenge trading is not a fruitful exercise. So get comfortable with doing nothing. Make sure you center yourself after a winner or a loser and only place a trade if you have a great deal of conviction in its success. A good trade should feel like you are shooting fish in a barrel, not like you are taking a punt or hoping it will go your way. Is there a fundamental catalyst? When you assess an entry point, it's good to check if there is a fundamental catalyst that is coinciding with the entry point. For example, if the price is breaking out, is it because of a positive surprise in some economic news that has the potential to move the currency further? If there is a good fundamental catalyst, then it can improve the probability of your entry success. You may even want to increase the position size on trades that have strong fundamental reasons for the entry. Market wizard Marty Swartz said, "I developed and synthesized a number of indicators that I used to determine when the market was at a lower risk entry point. Here are a collection of entries you can use for your trading system. These can be used both on the original time frame of the trade or they can be used on a lower time frame, so you can be very precise in your entry. Candlestick patterns. Candlestick patterns can be excellent representations of the short-term buying and selling pressure in the market and can be used to time entries. There are a lot of candlestick patterns and formations, but for our purposes here we will only look at two. Just remember they only tend to work well if they are used in conjunction with a setup. The first pattern is known by a few names, but we will call it a pin candle. To see this pattern you'll need to switch your chart to a candlestick chart. A pin candle occurs when there is a sharp reversal of the price within a time period and is a strong sign that the price is about to change direction and reverse. You can see here an example of what a pin candle looks like. As you can see, the candle has a small body and a long tail or wick. You would enter into a trade in the direction of the market, especially if there is a fundamental reason for doing so. The next candlestick pattern that is of interest is called a bullish or bearish engulfing candlestick pattern. Again, this pattern is prevalent at market reversals. Here is an example of bullish and bearish engulfing candles. The key in each case is the second candle in the pattern is larger than the first. The second candle should engulf the first candle. If you get a bullish engulfing, it is a sign to buy. If you get a bearish engulfing, it is a sign to sell. Here you can see candlestick entries in action on the Great British Pound USD. Trend breakouts after consolidation. A breakout from consolidation entry is used when an existing trend pauses and consolidates for a period of sideways movement before the trend resumes. Ideally what you want to do is look for a consolidation setup and then move to a lower chart to stalk the entry. The entry occurs when the price breaks out and closes above the range. With this entry you should generally have a tight stop loss, as the price will either break out and continue in that direction or fall back within the range quickly. Low volatility breakouts. Perhaps my favourite type of entry, the low volatility breakout, is the epitome of a low risk high reward trade idea. When prices compress into a tight range, they can expand rapidly in a strong directional move. This gives you a good place to put your stop loss, and if the trend continues, it can result in a big win. Low volatility entries can also be good situations in which to scale into positions as the move goes for you. To trade this setup, I use Bollinger Bands. Simply wait for the bands to compress and then take a position once the price breaks out. Here is an example on the Euro-AUD currency pair. The old-fashioned moving average crossover. It's very easy to identify a moving average crossover, which is a big plus for using them as entries. You can also vary the speed of the moving average to suit your objectives. The way a moving average works is to identify the strength of the trend. Once the trend reaches a certain velocity, the faster moving average will cross over the slower one, which gives you a signal to take a position. This means you are always buying or selling with the trend. A moving average crossover can also work as a counter-trend entry. If the price bounces off a support or resistance level and the moving averages cross, it could be a good time to enter. I like to use a 3-period moving average combined with a 7-period moving average. Once the 3-period moving average crosses over the 7-period moving average, it provides an entry signal. I will also displace the shorter moving average 1 period forward in time to make it easier for live trading. Here it is in practice in a trend on the Great British Pound USD. As you can see on the chart, the moving average crossover can get you into some nice trends. Simplicity will have its rewards. One of the best ways to master the art of trading is to pick and choose a limited number of techniques first and then get to grips with them. Select 1 or 2 entries that you like and practice them. Be patient when you hunt for entries and keep them simple so you can act decisively when the time comes. In this lesson's coursework you will select the entry points for your trading system. I'll see you in the next lesson.